Hello traders, Gary Wagner here, just about 10:30 in Honolulu, 3:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 30th day of January 2015, and this is the daily report for gold and silver, our weekend review. And what a week we have seen. Market across the board, dramatic days up, dramatic days down. We are finishing the week lower on the week, tremendously higher on the day, up about $24, getting back the majority of the losses that gold prices incurred yesterday. It is currently up, as I said, about $24 on the day, the low $12.58.60, the high $12.83. Silver also trading higher on the day, up about 1.7%, 30 cents higher on the day. 1723, that is our current print on the screen. Considering yesterday's dramatic drop of almost 6%, you can see that here on this daily chart. We've gained back roughly about a third of yesterday's sell-off. Low today, 1679, high 1727. More on silver towards the end of the show. More than anything else, the one thing that we can say about our activity this week in gold and silver, and especially the last couple of days, is we've had an absolute turnaround from what we witnessed yesterday to what we witnessed today. Dramatic sell-off in the precious metals markets, tremendous rally in the equities markets. That was yesterday. Today we've got pretty much the opposite. Sell-off in the equities markets. Dollar's still strong though, and we are getting a tremendous boost in price in the precious metals market. On today's show, there is a couple of topics that I do want to cover. First of all, we did exit our first trade of the year, so I kind of want to go and do a review on that. I also want to talk about what I am looking at next week in terms of our basic outlook and strategy. Now, we're going into the close of the market. Market's trading near the highs, or at the highs, I should say, at around 1283 and change. We've pulled up a weekly chart, and the reason I think this weekly chart speaks so loudly to us, this is the weekly candle right here, and that is because it has closed lower. No doubt we've got a red candle. You can see it now. It is a red candle, and so that means that, in essence, what we looked at is the market opened at this point here and closed at this point here on the week. However, the real telling sign, the real action, is this low that it hit when you consider that this market came down. I believe it was roughly at around $12.52 in terms of a low, and is closing $30 off of that low. Tremendous range in the marketplace itself, and tremendous two-day kind of a switch. In other words, we had seen this market moving up. We saw it hit a top. The top that it hit was roughly at 1308 and then began to come down, which brings us to our trade. We did exit our trade in gold and silver with a profit. Let me pull up another chart so we can review that trade. So really, I think the best chart to use to review our last trade is this half-a-day standard candlestick chart. There were a couple of primary factors that motivated us to enter our trade from the long side. One of those factors was the fact that we were looking at this long-standing resistance line, and as this market came up off these lows, we did see a series of higher lows, but each time we got those higher lows, it seemed to stall once it hit the upper band of this resistance line. However, that all changed roughly at the beginning of January. Here is January 2nd. I think we entered it I know it was the first week of January, within a couple of days of the new year. But as this market broke above this particular line right here, we sent out a trade alert suggesting that our clients get long both gold and silver. Clients that took that trade got in at 1217.5. Now, we initially put our stop below $1,200. So we risked roughly $20 on the trade. And one thing that you have to realize is when you consider the kind of ranges that we see in gold where it's up $20, up $30, followed the next day by down $30, or in the case of what we're looking at today, down $30 yesterday, up $25 today, you've got to have a pretty wide stop if in fact you expect that to protect your equity and at the same time allow you the ability to make profits if you're correct in your overall assumption. So once we entered that trade, the market did backslide. It hit a high of about 23. That's right here. And then began to slide back lower. You can see the slide here. Probably, I think it was about 1208 or maybe even 1210, somewhere in there. These are the lows that we're looking at. So our stop held, and then the market reversed that downward move and started to move up. And as it moved up, we began to trail our stop up. The first place that we put our stop was roughly at just under 1225. The market came down. It tested close to that area, but the stop held, and then we had this really strong parabolic rise. And as this market began to rise, I believe the first place we moved our stop up to was approximately 1252 or just below 1254, and it was based on a fib retracement number that we were looking at as well as a prior top in the market. Stop held there, and then as the market moved up more, we placed our stop here to below 1274. So the market comes up, it makes this intraday high at 1308, which takes us to another point that I do want to make about this trade, and that is that initially when we put this trade on, our belief and our target was anywhere between 1300 and 1312 were the numbers that we were looking at for the potential move before we'd see any kind of a retracement in the market. So we pretty much hit our mark here, and once we did and the market began to backslide a little bit, as I said, we moved our stop to 1274. Market came down, did hit our stop, and we marked ourselves out at 1272, which was the low of that particular day. So we got in at 1217.5. We got out at 1272, and we picked up in terms of profits a little bit over $5,400 per 100 ounce contract, which would in essence, considering that the margin required is $4,000 behind silver, you would have doubled your money on straight margin. Which brings me to a question that I do want to answer. It was an email that I received earlier in the week, and this was one of our subscribers that was looking at our track record and noticed that there were times we, so to speak, doubled up. In other words, where we added to the position, and his question was, should we always be holding back some of our equity or be fully invested or vested into the market each time we trade? For those of you who have been with me for a while, you know that my belief is that we want to make margins work for us, but we don't want the leverage amount that the exchanges are willing to give us. So my belief is, if in fact the margin requirement for a contract of gold is $4,000, put $8,000 behind it. Go 2 to 1. In other words, give yourself the flexibility to add to the position if you need, and also to maintain a less of a leverage status so that you can control risk reward a little bit better. Specifically risk in this case. Of course, reward works in your favor the more you're leveraged, but it also works against you, of course, when the market's not moving in our favor. So I always recommend not being fully vested in the market in terms of what your equity is in the account compared to the size of the position that you put on. So again, in at 17.5, out at 72, a really good trade to start out the new year. Now, that was yesterday, and we were really, really pleased as this market came down and it touched these bottoms. But lo and behold, it has had a complete and utter turnaround today. So the next question is, what is our strategy for next week? And so to look at our strategy for next week, I really want to dissect for a few seconds the most recent activity we've seen in the market and show you the model that I'm currently looking at. Absolutely. We hit a bottom back in November when this market came down to 1130. Now realize these are very much a sub count, but if we take a look at the first part of this rally, which took the market from roughly 1130 up to 1238, and then we look at this as, call it a sub count wave 1 right here. Then we had a correction in the market. And if we look at the correction in terms of where it came in at, these are the lows. If we take a look at this number, which is 1171, that becomes a 61% retracement of this move up. Very, very plausible corrective action within the marketplace itself. So we would look at this in terms of a subcount. This would be a wave 2. That being said, we're probably in a wave 3. Again, these are subcounts. We're using a daily chart, and you'll get really 5 of these. You'll get 1, 2, 3, 4, 5 ABC, 1, 2, 3, 4, 5 ABC. But so this being our third wave, remember when we look at a basic Elliott wave model, wave 3 cannot be the shortest of any of the impulse waves and is typically 1.5 to 1.61% that of our wave 1. What I've done is I basically put a fib extension into this equation. So if we're looking at a wave 3 right here, and that wave 3 takes us, for example, to a 150%, that takes us to 1328. And if we then compress the chart, this is that target really that I believe we're going to at least go in and attempt to take out, because that is a former top. And to see that, let's go ahead and compress this a little bit. And so you'll see where these tops begin to line up in terms of previous tops in the market. We have one top right here. And again, I'm going to try and lay this in as straight as possible. This roughly at 1321, 1328. We have another top here. And this top, I believe, comes in at 54, if I'm correct. So we have a certain sweet spot or an area that I believe this market could achieve in terms of a price move or price ascent to the upside. And that sweet spot, so to speak, in other words, my target area would be roughly in this area. So the question is, how do we position ourselves to get the best out of this trade? Well, I saw the market come down yesterday. And for those of you that saw yesterday's show, my comments were basically, let's let the dust settle and see if that's going to be the low. If it's not, it's probably going to go as low as maybe, call it 1240, 12 in this area, and it was based upon these tops here. We never got close. This market, this was the low. We talked about where that low came in on yesterday's show. You can go back and revisit that if you need to, but this was based on a fib number. So in fact, if what we're looking at then is, again, our subcount, wave 1, wave 2, wave 3, wave 3 should be able to take us, as I said, anywhere between 1321 and take out this top to approximately 1350 to take out this prior top. But these are the tops that this market needs to take out to give us the confirmation, because we need to see not only higher lows, which we're absolutely getting, but we need to also get higher highs, which we absolutely got. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for another daily update and review. We will send out a special trade alert as soon as we believe that the most prudent move is to re-enter. And as I said, I would be looking to re-enter from the long side. As far as silver goes, if we do enter the market on the long side in gold, we will look to enter it in silver. But there's some cautionary moves in silver It really gave up a lot yesterday. We had a great trade. We pulled a dollar out of the market, but we saw a dollar move in just one day. So I want to be cautious in silver. Again, have a great weekend. For those in the States, have a great Super Bowl Sunday. We'll talk to you on Monday for another daily update and review. Bye-bye.